Hello and welcome back to Perfect Spiral Capital. My name is Luke Tatum. I'm an authorized infinite banking concept practitioner, and today we are doing another reaction video. We're going to be looking at a brand new video from Rachel Cruze, Dave Ramsey's daughter, part of the Ramsey Solutions family, and she has a video called How to Set Financial Goals at Any Income Level, which I will pull up on the screen now. I have skipped the beginning of the video, which is just sort of the introduction and kind of setting up, but what she's going to do is walk through the Ramsey Solutions baby steps, and I thought it would be fun to go through these and talk about where we agree and where we disagree with this plan that Rachel Cruze is laying out. So, without further ado, let's get into it. And I think this will be a lot of fun. Thanks for watching.
And so, like I said, there are 7 steps. We call them the Ramsey baby steps that allow you to take full control.
Okay, I'll pause just really quickly here so we have some time to look at this. We've got save $1,000 in a starter emergency fund, pay off all debt except for the house, save 3 to 6 months of expenses for emergencies, invest 15% of your income for retirement, save for college for your children, pay off the house, and build wealth and give. Now, she's going to start with the starter emergency fund. We'll talk about each piece as it goes. Just so you know, I have a book that is an Amazon bestseller. It's called Between the Lies, How to Reclaim Your Future from the Banks and Wall Street. And honestly, philosophically, I align very much with Dave Ramsey. However, he is extremely anti-infinite banking, as you may have seen in my other reaction video to Dave Ramsey and Graham Stephan, which you'll find a link to below. But we'll get into all that. So let's go through these steps.
Control over your money, your building wealth, goals, achieving financial peace, all of it. So these are steps that actually my dad, Dave Ramsey, created, and realizing that walking people through not just a set of principles, because principles are important, but actual steps where you can see progress is really, really key to winning with money, because so much of money is behavior change. And when you know that you're doing something and checking something off the list of like, I did step 1, I did step 2, there's something in us that keeps us moving forward in that.
Completely
Now,
agree.
let's go through those steps in order so that you can figure out exactly where you fall. So step 1 is to save $1,000 emergency fund. So again, starter emergency fund. This is not your forever emergency fund, but it's to get you started. Now, some people complain that $1,000 isn't enough, and at times it's not. So that means you will have to pause your other financial goals at times when you're paying off debt, especially, to save up more money, to bump up that emergency fund if you need it. But that's what's key, is that it should kind of drive you to be paying off debt, because that's step number 2. But if you try to pay off debt without an emergency fund, then you'll end up going back in debt if something happens. And then also, some people want a bigger emergency fund, and it takes you longer to be building up cash for an emergency fund while you're still paying out all this debt and all this interest. So it's easier just to get a quick start on debt and free up that income, because that's where you're going to see progress. So again, starter emergency fund. Step 1 is $1,000.
All right, so she's about to move into step 2. Save $1,000 is step 1. I'm fine with step 1. Save $1,000. Yes, it's an arbitrary dollar amount. Yes, you might prefer to have more, as she alluded to. Ultimately, the exact dollar figure is not what's important. If you had $900 and that works for you, great. But a lot of things can cost upwards of $1,000, and those can really derail your good effort getting started with a debt repayment plan and moving towards some of these other things. So, step 1, I don't really have a problem with step 1. Saving $1,000 is a wonderful thing. If you don't have $1,000, it's time to step that up. We keep more than $1,000 in a savings account, and we do infinite banking. I don't like banks, but I keep more than $1,000 available in the bank because it's immediate liquid access. If I'm on the side of the road and have no other way to access money, well, hey, I've got a debit card. I can do a bank transfer from my phone from savings to checking, and we're okay, right? So no problem with step 1. Let's keep going, though. I'll have a lot to talk about She touched on interest, and we'll definitely talk a lot about interest here in a moment.
Step 2 is paying off all of your debt but your mortgage. So this is going to include student loans, credit card debt, car payments, personal loans. Anything that is revolved around debt except for your mortgage is in this process. So you're going to list out all of your debt, smallest to largest, regardless of the interest rate, pay minimum payments on everything, and attack the smallest one first. Once that's paid off, you're gonna be able to take the payments that you're paying on that, roll it over to the second smallest debt. So it keeps freeing up, again, these payments, and you're able to build momentum, and it creates a snowball effect. Okay, once that is all done, then you can.
And of course, that's like the shortest thing that she's talking about here is, oh yeah, just pay off all your debt, no big deal, right? So yes, I know that they talk about repaying debt all the time at Ramsey Solutions. I'm not trying to minimize this video. It's a quick video. That's one of the reasons I'm doing a reaction to it, because it's short enough to do a good reaction. But repaying all your debt is something that I resonate with. It's something that I try to encourage my clients to do, all of the clients, for all of the members of our team here at Perfect Spiral Capital, try to get people out of debt. Because if you don't do that, a huge portion of your income on a monthly and annual basis is going to pay other people in it. You don't own or control those entities, right? You don't own Bank of America. If you have a loan from Bank of America for your mortgage, then it doesn't help you any when you make those interest payments, right? It helps you that you got the house, but it doesn't help you any to repay those payments, those interest payments. Amortization means that your first payments for the first several years are going to be very, very, very interest heavy. A majority, in all likelihood, is going to be going to interest to the bank for years out of each payment that you make. So what do you do about that? Well, that's really the point of our strategy, the Truth Blueprint. We have 5 steps, as I mentioned before. It's take responsibility, reclaim your money, undo your debts, transcend your expenses, and help others. You'll notice some parallels with the 7 baby steps that we're going through right now. But where do our steps differ? This is where that starts, okay? Step 2 in our process, the R in the word truth, is reclaim your money. And that is to understand and implement the infinite banking concept in your life. This is using life insurance as a foundation for your financial life. A properly structured, dividend-paying whole life insurance policy is a superior place to save money. And so if we have more than we like to keep in immediate liquid access in a savings account, it moves from that savings account to one of these life insurance policies that we have and have used for years now. And we're able to tap into that on a contractually guaranteed basis and fund things that we need to fund. And when we pay interest, because we're tapping into that asset using loans, when we pay interest on those loans, the interest is going back to an entity that we own and control. And that benefits my family. Okay, so getting out of all debt in our system means getting out of all debt to third parties that you don't own and don't control. And there are multiple ways that you can attack those debts. I'm a fan of the snowball method, which she just described, which is lining them all up, smallest balance to largest balance, because it gets you an early win. It gets you some debt paid off and cleared off the table. It reduces your total number of outstanding loans quickly because you focus on the smallest balance. So yes, make minimum payments and then focus on either the smallest balance or perhaps the highest interest rate if it's a manageable, achievable goal, or perhaps you use something like the cash flow index to determine which one of those debts is the most inefficient from a cash flow standpoint. That's a little bit more of an advanced idea. At Perfect Spiral Capital, we're here to help you do that. We have a worksheet to go through for our clients to walk through this process and determine which debts need to be attacked first. That's something that we offer. But with the pay off all debt step here, yes, you should do that. For us, it's step number 3, but it's get a hold on your financial situation, understand and implement the infinite banking concept, and then undo your debts. Get out of all these third-party debts. It's okay to finance things because you finance everything that you buy, and there's no getting away from that. Dave Ramsey in Ramsey Solutions talks about paying cash. Okay. Now, we used to use the Ramsey Solutions, tools. We used to embrace Dave Ramsey's teachings, my wife and I, and it's not that it's wrong and will put you in a bad place. It's just that it's not fully correct. Okay? Paying cash still has an interest rate. This is a absolute truth that you have to understand. If you have your money in a savings account and the savings account pays you 3%, when you take the money out of the savings account and you go spend it on something, a car, then that money is no longer in the savings account. The opportunity cost is the interest that you have given up forever from that savings account. Now, you may have an even better place to put money, aka a properly structured dividend-paying whole life insurance policy. Talk more about that. There's lots of videos on this channel that talk about that. But you're giving up something. Where your money could have been if you didn't spend it is an opportunity cost. It's the same thing as financing it. You're either paying interest to a third party, paying interest to an entity that you own and control, or you're giving up interest, which is costing you money, by spending cash. There is no interest-free option, even if there isn't interest written down on a piece of paper or displayed on a computer screen somewhere. There's always an interest cost. Interest is the price of time, period. But yes, you should get out of debt. And what we teach is to use your superior savings platform, which is a dividend-paying whole life insurance policy, to get out of debt. We teach you to become your own banker. And if you have a bank, what does a bank do to make money? They make profitable loans. If you have a bank, you want profitable loans. So your bank that you own and control should acquire the loans from the other lenders that you're already paying. Somebody else is making a very good living off of you right now if you have outstanding third-party loans. Why would you not want to direct that interest to an entity that you own and control? That is the question that Dave Ramsey will never answer on the air. And, it is what it is. Let's keep going.
Move on to step 3, and you're going to bump up that starter emergency fund to 3 to 6 months of expenses. And you can do this in a high yield savings account. But the idea here is you don't want to invest this account. You want to be able to get to it if you need it. So if a job loss happens, medical emergency, you have a lot of money saved in the bank just for emergencies. Okay, this is, I think, a big accomplishment. Once you get past maybe step 3, you are completely debt-free but your house, and you have money saved in the bank already. That is a massive financial milestone that I think you really do feel in so much of your life. You feel so much peace. And again, it is so necessary to keep going, right? We don't want to slow down. But in those 3 steps, you guys, it is full intensity. And then once you complete those 3 steps, the next steps, again, we say you can take your foot off the gas a little bit and it's more okay. We're still going to work towards some things, but you don't have to be that intense. So step 4.
Okay, before she gets into step 4, I have to talk about high yield savings accounts for a moment. That's all the rage. Everybody everywhere is talking about just put your money in high yield savings accounts. You'll get 4.5%, 5%, 5.5%, whatever the percentage rate is. Okay. But again, we just talked about opportunity costs. We just talked about that there is always an interest rate associated with spending cash, right? So if it's just sitting there and you never touch it and you never use it and it never does anything for you, yes, it'll earn this interest rate. As long as interest rates are what interest rates are. I happen to have connections inside of some finance companies, some of the big payment processing companies, and I can tell you with 100% certainty that high yield savings account rates are not going to be what they are forever. This is a fad in some sense at this exact time. And when interest rates get cut, when the Federal Reserve decides that it's going to do some quantitative easing, guess what? Those high yield savings accounts are gone. If you still have one, the interest rate will get cut. If you go into a bank after interest rates get cut and ask about their high yield savings program, they will act like they never offered consumer high yield savings. I've already heard from clients of mine that have told me this experience. They had a flyer that they received from the bank about a high yield savings. The bank became nervous that the Fed might cut interest rates. And so when they came back in a couple of weeks later to say, hey, I'm interested in one of those high yield savings accounts, they were told that there is no such thing. They don't have those for clients or for consumers. They just have them for business customers at this point. And so, let's not be living with rose-colored glasses on. Let's not pretend that interest rates are always going to be what interest rates are right now. Historically, interest rates are still very, very low compared to what they have been in the most recent 30 and 40-year period. But no one seems to talk about that. We have had, especially, say, since 2008, a majority of this time since 2008 has been extremely, extremely low interest rate environment. And in that kind of environment, a high yield savings account is not a thing that you can depend on to get a good rate of return. It's just not. So that is one thing that I just have to disagree with. A high yield savings account has a whole lot of problems. And we can solve many of those problems utilizing an infinite banking strategy that is available and can be used and doesn't depend on the current interest rate environment. So maybe we should consider that. All right, the other thing here is the amount of money. 3 to 6 months for emergencies. 3 to 6 months of expenses is a wonderful goal. I completely agree. You should try to save that much money. You should save that much money. But where? An insurance-based platform, a whole life platform, a whole life insurance platform that has been designed by an authorized practitioner that thoroughly understands the insurance products available and what is and is not appropriate for such a purpose is wonderful. Whole life insurance means you have guaranteed access to the money. That is better than a bank. A bank can declare a bank holiday. A bank can have a bank run. There are many occasions in which even if your money is in the bank, you can't actually access it. And so, unlike that, a whole life insurance policy lists you as the owner of the policy. You have ownership even before the insurance company of the funds in that account. And they must give it to you if you request it. Contractually guaranteed. A bank has no such guarantee. The amount, though, 3 to 6 months, I think that's great. Is it 3 months or is it 6 months? That's up to you. Think about the things that could go wrong and how much money you could set aside and how much money would make you and your partner feel comfortable, and then target that. However, if you are saving in a dividend-paying whole life insurance contract, then your amount saved will always be increasing on a contractually guaranteed basis, period. And so it's not, I'm going to save up $50,000 and then it's just going to sit there. It's, we're going to save diligently. We're going to put this system in place. We're going to enforce this savings plan. And we're going to have $50,000 over a certain period of time. And then we're going to have 60. And then we're going to have 75. And then we're going to have 100. And it's going to keep going and keep going and keep going throughout your lifetime. And so it doesn't matter 3 to 6 months is just a midterm goal or an early term goal. It depends on what your income is. It depends on how much you're saving. It doesn't particularly matter because it's just a specific point on a continuum. You're going to have so much more money than that in a very safe, protected account with contractually guaranteed access that you're not going to think of it in terms of months of expenses. It's going to be a volume of capital that you can deploy for the purposes that you need in your life, which includes investing and all these other things. We'll talk more about that on the next point.
Is to save 15% of your income into retirement. So there's different ways you can do this, but always remember this. Match beats Roth beats traditional. So let's say you have 15% of your income and your company matches 5%. You'll take part of that 15%, 5% of it, put it into your 401k. That means you have 10% left. Then I would go and fund a Roth IRA. If you max it out with 10% that's left and you have 2% left, then go back to your 401k and you can fund that. But those are two great options, a 401k or a 403b and a Roth IRA. So be looking into those because, again, I think it's key. And if you want to check out our investment calculator at RamseySolutions.com, plug in some numbers and just see what compound interest does. It's a beautiful thing. All right, step 5 is...
Okay, I have a lot to say here. I have to resist the urge to make this a 2-hour long video. I do not recommend this step. This step belongs later, and what the spirit of this step is belongs earlier in the list. Save 15% of your income would be a wonderful thing. I don't care if it's 15%. It could be 10%. But save money, save a substantial portion. I would say 10% is an excellent goal. And do that up at the beginning. When you start saving, you're going to get to $1,000 pretty quick. Keep saving. Save in a dividend-paying whole life insurance contract that's been properly designed to use as a cash flow tool, and you're going to blow right past $1,000. And then you're going to get to 3 months of expenses. And then you're going to get to 6 months of expenses. You're going to blow right past those too. You're going to keep going and keep going. You're going to have multiple years of income saved. And you can always access it on a contractually guaranteed basis. Not to beat a dead horse, but that's how it works. And it grows. It might not, depending on how you think of this, grow the same way that an investment in the stock market might grow. But a dividend-paying whole life insurance contract does not have down years. It goes up every day. And those are completely different things. She talks about compounding. The stock market does not have what is ordinarily understood as compound growth. If I put money in a savings account, high yield, regular savings, it doesn't matter. If I put money in a savings account that earns 3%, I earn 3%, then I have the starting investment plus 3%, and that amount earns 3%. And then the larger amount earns 3%, and then the larger amount earns 3%. And so the 3% becomes a larger and larger amount of dollars, and that's compounding. And it's uninterrupted compounding until you touch it. This is one of the primary things that I set out to describe in accurate, understandable terms in my book. Between the Lies is 99 cents on Kindle, and it in detail breaks down how compounding works. Okay, that is not how the stock market works. The stock market has down years. Sometimes it has multiple down years in a row. The way that average annual rate of return is calculated for these purposes is to say, okay, you've got a 25% growth here, you've got 10% growth here, you've got negative 30% growth here, or negative 30% return. You've got, you take all those percentages, You add them up. Say you take a 10-year period, you add up all those percentages, and then you divide by 10. Whatever that number is your average annual rate of return. If you take that number and multiply it on a starting investment times the number of years, that's a completely different number than what actually happens if you put money into a stock investment, such as a mutual fund, and watch it over 10 years. Doesn't do average annual rate of return times number of years. That's not what occurs. That is a lie. And it's a lie that unfortunately millions of people believe. So, without pulling up a bunch of spreadsheets and talking about that in detail on this video, I don't agree with that. And what's more important, saving 15% of your income in a place, investing 15% of your income in a place where you cannot touch it and it cannot improve your life, your day-to-day needs, it can't help you pay off debts, it can't help you in any way today, it's got to be set aside for all this time, years and years and years, decades in the stock market, or to save that money in a place where you can access it, so you can deploy it to repay loans, you can better your financial situation and your overall well-being now over the next few decades. And then, oh, by the way, you also still have all that money when you reach retirement. So which one's more important? If you're saving 15% of your income in a dividend-paying whole life insurance contract that's properly designed for this sort of purpose, you're going to end up with a lot of money in that account. Period. You're going to end up with a lot of money in that account, guaranteed, regardless of whether or not it earns a dividend. Now, the stock market investment sounds great in theory. It looks good on paper. You end up with this huge balance. But that total balance ebbs and flows and shifts and goes up and goes down. And what if you need to retire and it's the eve of the 2008 so-called Great Recession? What if 40% of your account balance is wiped out and that's the last year you were planning on working? Well, depending on what you were invested in, it might have taken you 11 years for your account balance to recover to pre-collapse levels. So is that the right decision? I don't know. Am I telling you not to invest in the stock market? No. But I'm telling you that this is not the only way, and it should not be a primary focus, and that you shouldn't be, while you still have a house payment, investing 15% of your income. 15% of your income would go a whole long way to getting your mortgage eliminated, owning your home free and clear. And by using the infinite banking strategy, by using whole life insurance as a platform for your financial life, which is what we do, then you have an opportunity to get out of these other debts. You can start small, you can grow the policy, you can pay off debts. And as you are doing that, as you are becoming debt-free, you simultaneously build a larger and larger and larger pool of guaranteed, accessible cash value that you can then direct towards the house. And then you can quickly eliminate your mortgage. And then you have no debt payments whatsoever and a lot of cash value in the policy. And then you can make investments. And it doesn't need to be a stock market investment. It can be investments into businesses that you understand. It can be investments into anything you want, because the life insurance company doesn't need to approve what the loan is for. The life insurance company doesn't ask you, oh, you're using this to buy a business? Could you please show me your business plan? They don't care. They don't ask. They're not going to ask. And it doesn't matter. They will give you access to the cash value in that policy because they must, because that's what it says in the contract that you signed. Just a thought. Let's keep going.
save for your kids' college. And so if you have kids, again, this is something that you can start doing and working towards because so many students have to take out student loans. And if you're a parent, that is a gift. It is not a requirement, but a gift to be able to help your kids when it comes to college. So putting money in a 529 account, I think is great, or an ESA, an educational savings account. But you can sit down with a SmartVestor Pro when it comes to your retirement and kids' college and really map it out. And so again, being able to set your kids up, I think, is such a gift when it comes to their education. All right, step 6 is paying the house off early.
I don't necessarily have a problem with saving for college. I've already discussed why I think there's an alternative to a high yield savings account or to these educational funding accounts, 457 plans, et cetera, et cetera. I don't think those are necessary. If you're doing the other things, you'll also acquire wealth that you can deploy for any purpose. You can deploy it for a wedding for your children. You can deploy it for paying for college, whatever you want to do. Whatever you want to do. It doesn't matter. We just covered that. So let's keep going.
So what you're going to see is you're going to be doing retirement, kids' college, and then anything else you have extra, just be throwing at the house. So you'll do 4, 5, and 6 at the same time. And this is one of those things that, man, you just keep moving at it. But when you're paying off your house and you pay off your house early at step 6, it is one of the most underrated things that you can do to increase your net worth and find a lot of peace. And on average, we have found that people working the baby steps pay off their homes in just over 11 years. So if you have completed all 5 steps, and usually that takes around 2, 3, 4 years to do, the rest of it, people are paying off their houses. So could you imagine not having a mortgage for 30 years, but for 7, 8, 9, 10, 11 years? It's amazing, absolutely amazing. So being able to take advantage of that, paying your house off, it's an incredible thing. And then once that's done, all that's
Okay, we kind of touched on this already, but paying off your house, I don't think you need to wait. I don't think you need to wait at all. I think you start reclaiming your money, which is step 2 in our process, and you start undoing your debts, which is step 3. Part of that is your house. I don't see the need to make your house a separate debt that doesn't count, sort of, until later, and it does not belong after investing. It doesn't. The more cash flow that you can free up, the more cash flow you can direct to savings. The more savings you can establish in life insurance, particularly, the more compounding your money will do on a guaranteed basis, day after day, for the duration of your life. The more of that you can put in force, the more of that you can get going, and the sooner you can do it, the better platform you have to do everything else. If the mortgage is your largest debt and it's your largest cash flow problem, get rid of it. Using policy loans out of these policies can dramatically reduce the length of time it will take you to pay off your mortgage. Yes, the baby steps can do that too. It's not to say that this won't work on some level, but you will end up in so much better a position if you have the dividend-paying whole life insurance policy system in place, if you're doing infinite banking. Because when you're working with us, Perfect Spiral Capital, we use mutually owned life insurance companies. That means that when they earn a profit, which is often, they pay a dividend. The dividend helps you grow your policy. It increases the compounding. It's wonderful. But it's also that we use what is known as a non-direct recognition policy. Non-direct recognition means that I can take out a policy loan from my policy or against my policy, and I can use those funds, say it's $100,000, I can send $100,000 towards the principal on my home, and while I'm doing that, I will earn the same dividend inside my life insurance contract as though I had not taken the $100,000 policy loan out. 401k loans don't work like that. It's not the same thing. If you want to talk about interrupting compounding, people interrupt the compounding in their stock market investments all the time. People take out 401k loans to renovate their kitchens. It completely ruins the theoretical, on paper, perfect thing that they're doing in their stock market investing every time they do that. And so you have this sort of false equivalency where it's, oh, I'm going to get all these gains from the stock market, but you're not if you're touching it. You're not if there's negative years of return, which there are. It's not an accurate depiction of what the stock market investments do. We won't even talk about the differences between 401k and Roth and all those other accounts. It's just that that's an investment. It has a potential for loss. It has a swing in value. It's not a platform for increasing your wealth. If you direct your funds to what you need to do now, if you improve your financial situation now by improving your cash flow, you free up the cash flow from your student loan, your car payment, your credit cards, your mortgage, all of those things, get them all gone. You will have so much cash flow to do investing, and you will be in a phenomenally better place. So pay off your house. That belongs way up there on the list. But you can do that while doing steps 1 and 3. You understand? It's all the same thing. You're saving, you're getting an emergency fund together, keep some cash in the bank, but build this asset, and you can deploy it for an emergency or to attack your debts, or both at the same time. And you're not giving up anything when it comes to the compounding growth, true uninterrupted compounding growth of those policies. Okay, let's finish this off.
What's left is baby step 7, to build wealth and give. So giving is part of your entire financial journey, regardless of where you are. I always say give a little until you can give a lot. But at baby step 7, that's when you get to increase and you get to be extremely generous, because all you're doing is funding investments and enjoying life and giving money away. And that's what you have left to do. And it's just wonderful. So no matter how many people tell you on the internet that your financial goals are dependent on your age, on your income, your geographic location, the truth is it really has to start with you deciding to make progress. Now, do those things factor in? Absolutely. But this idea that you have the ability to take control of your money is huge. So use the baby steps, you guys. It is a proven plan to be able to get control of your money, get out of debt, save for the future, and all of it. So if you have not been budgeting is going to help you in this process. Make sure to check out Every Dollar. I'll leave a link down below.
Okay, she's just getting into her final plugs and everything. You do not have control of your money if it's in the bank, period, full stop. That's not true. It's actually been upheld in case law going back to the United Kingdom for over 200 years. Your relationship with a bank is that of a creditor. You are technically lending money when it comes to the legal truth of the matter. According to the law, you are lending money to the bank when you deposit money into a bank account. That's also in my book. If you want to check that out, it's in the description box below. How to Reclaim Your Future from the Banks and Wall Street. The book's called Between the Lies. It's because there's a lot of lies and it's hard to navigate them. And there are footnotes and footnotes and footnotes in there to back up everything that I say. Okay, this last thing. What we call this last step is help others in the Truth Blueprint. So the H in Truth is help others. And that is the same kind of things. It's estate planning. It's charitable giving. It's all of those things, helping other people to understand and to implement these steps and to get in a great financial situation themselves. The effects, particularly using a life insurance platform, a life insurance strategy, aka infinite banking, the effects of this on a multi-generational level are astounding. But it starts with you. And so again, like I agree with most of the things that Rachel says in this video. Yes, it starts with you. Yes, it's an internal thing. Yes, you have to decide that you're going to take control of your money. But taking control of your money is getting it away from the bank, because you don't control the bank. That's not how it works. Yes, you should be debt free, but you should be debt free using a system that benefits you while you're becoming debt free and after you're debt free. The effects that you're going to get, the positive benefits that you're going to get from following the 7 baby steps, are enhanced and improved by using the truth blueprint, period. And it's just because the Ramsey Solutions family does not acknowledge that paying cash has a cost. That is the key understanding. I hope you found this video helpful. I had a great time doing it. If you want to learn more about what sets us apart from the 7 baby step system, from Dave Ramsey's advice, who I still hold in high regard, that's what we're here for. You'll find a link below. You can set up a free consultation with us. We're not trying to sell you anything. We're just trying to set you on the path. The first thing on our steps is to get you learning. And so we're going to direct you to the right educational materials, get you thinking about things in a new light, and to see the lies that so many people are trapped between. Thanks so much for watching. There's going to be another video coming up at the end of this one. And if you like this video, you'll probably like that one too. Thanks so much. I'll see you in the next video.